Michigan just eliminated its pension tax completely. For 15 years, Michigan retirees have been paying state income tax on their pension income, a tax that didn't exist before 2011, a tax that punished people for retiring in Michigan. That tax is now gone. Repealed, eliminated, finished. If you're a Michigan retiree, your tax bill just dropped by hundreds of dollars, maybe thousands of dollars, every single year for the rest of your life. If you've been paying this tax, watching that money disappear from your pension check, wondering why Michigan treats its retirees like ATMs, the bleeding finally stops. If you left Michigan because of this tax, packed up and moved to Florida or Tennessee or anywhere that didn't tax your retirement, the door is open to come home. Let me show you exactly what changed and what you need to do to claim it. If you're retired in Michigan, planning to retire in Michigan, or have parents wondering what this means for their budget, subscribe. We cover the tax changes the moment they happen, the fine print that determines how much you actually save, the deadlines and forms that matter. No jargon, no confusion, just the information you need to keep more of your money. Hit subscribe, takes 1 second. This is the biggest retirement tax change in Michigan in 15 years. Let's break it down. Michigan has officially eliminated state income tax on pension and retirement income. The phase-out that began in 2023 is now complete. 2026 is the first full year with complete elimination. And I mean complete. Public pensions, state employee pensions, teacher pensions, police and firefighter pensions, municipal worker pensions, all exempt. Private pensions, corporate pensions, union pensions, defined benefit plans from any employer, all exempt. 401 KEC distributions, whether you're taking regular withdrawals or required minimum distributions, exempt. IRA withdrawals, traditional IRA distributions that used to be fully taxable, exempt. 403B distributions for teachers and nonprofit workers, exempt. Social Security was already exempt in Michigan, has been for years. Now everything else joins it. Michigan went from one of the worst states in the Midwest for retirement taxation to one of the best. In 3 years, an estimated 500,000 Michigan retirees will see tax savings from this change. Average savings? $1,000 to $2,000 per year. Some retirees with larger pensions will save significantly more. That's real money. That's groceries. That's prescription costs. That's staying in your home instead of wondering if you can afford the property tax bill. But here's what most people don't understand. This isn't a new tax break. This isn't the government suddenly being generous with retirees. This is the restoration of something Michigan retirees had for decades. Until 2011, Michigan used to exempt all pension income from state tax. Your parents retired here and paid nothing on their pension. Your grandparents paid nothing. Then one governor, one bill, one signature, and it was gone. 15 years of Michigan retirees paid a tax that previous generations never paid. A tax that appeared out of nowhere and landed squarely on people who couldn't fight back. Now it's finally being undone. The wound is finally healing. But it took 15 years, and a lot of damage happened in those 15 years. Let me take you back to 2011. Michigan was in trouble. The Great Recession had gutted the state budget. The auto industry was on life support. Tax revenues had collapsed. Governor Rick Snyder came into office promising to fix Michigan's finances, balance the budget, make tough choices. One of those tough choices landed directly on retirees. In 2011, Snyder signed a law that fundamentally changed how Michigan taxed retirement income. Before 2011, pension income was exempt from Michigan state income tax. Had been for decades. Retirees paid nothing on their pensions. That was the deal. That was what people planned around. After 2011, everything changed. The new law created a complicated tier system based on when you were born. Born before 1946? You kept the full exemption, grandfathered in, nothing changed for you. Born between 1946 and 1952, partial exemption with income limits. You could exempt some pension income, but not all. And if your total income was too high, you lost the exemption entirely. Born in 1953 or later, no exemption. Full taxation on your pension income at Michigan's 4.25% rate. Read that again. If you were born in 1945, you paid 0 state tax on your pension. If you were born in 1953, you paid full tax on every dollar. 8 years apart in age, completely different tax treatment, based on nothing but when your parents happened to have you. The younger you were in 2011, the more you got punished. People born 1 year apart had completely different tax bills. It made no logical sense, unless the logic was simply this: phase in a tax increase slowly. Let the oldest retirees keep their exemption so they don't riot. Tax the younger retirees who have more years of payments ahead of them. Spread the pain, minimize the backlash, maximize the revenue. It worked. For the state budget, for 15 years. It didn't work for the retirees who paid it. The 2011 change was sold as necessary. Michigan was in crisis. Sacrifices had to be made. Everyone had to do their part. But here's the thing about that sacrifice. Retirees weren't the only ones who sacrificed. They were specifically targeted. Corporations got tax cuts in that same 2011 budget. Business taxes went down. Retiree taxes went up. The burden shifted. From businesses to seniors, from corporations to people on fixed incomes. And for 15 years, Michigan retirees have been paying a tax that felt like punishment. Punishment for choosing to retire in Michigan. Punishment for staying when other states rolled out the welcome mat. Something happened after 2011 that legislators didn't fully anticipate. Retirees started leaving. Not immediately, not dramatically. The exodus was quiet, gradual, a trickle that became a stream. Year after year, retirees looked at their tax bills, looked at the weather, looked at states like Florida and Tennessee and Texas that don't tax retirement income at all, and they made a decision. Michigan has one of the highest rates of retiree outmigration in the Midwest. Tens of thousands of retirees leaving every year, taking their pensions with them. They went to Florida and bought condos. They went to Arizona and escaped the winters. They went to Tennessee for the music and the zero income tax. They took their spending with them. Restaurant meals they would have bought in Grand Rapids, now spent in Tampa. Home repairs they would have hired out in Ann Arbor, now contracted in Phoenix. Property taxes they would have paid in Detroit suburbs, now paid in Nashville suburbs. Sales tax on everything they buy, now going to other states. Their economic activity, hundreds of millions of dollars every year, packed up and moved with them. The pension tax was supposed to raise revenue for Michigan. That was the whole point. That was the justification. But how much revenue did Michigan lose when retirees packed up and left? How many property tax dollars walked out the door? How many sales tax dollars? How much economic activity? Studies started coming out. Analysis of the actual impact. The numbers weren't good. The pension tax was a net negative, driving away more revenue than it collected, costing Michigan more in lost economic activity than it ever raised in pension taxation. The tax was a failure, not just morally, economically. Legislators started paying attention, slowly, reluctantly, but they paid attention. Restoring the exemption became a bipartisan priority. Democrats and Republicans agreeing on something for once, because the evidence was undeniable. The pension tax was hurting Michigan, and it had to go. So now it's gone. The pension tax is eliminated. Full elimination as of 2026. But the elimination didn't happen overnight. It phased in over several years. Partial relief in 2023, more in 2024, more in 2025. If you haven't been paying attention, you might have missed tax savings you were entitled to. You might have filed your 2023 and 2024 taxes without claiming the partial exemptions. You might have left money on the table. Money the state owes you. Money you can still claim by amending your returns. Let me show you how the phase-out worked, and make sure you're claiming everything you deserve. Michigan eliminated the pension tax. Retirees are celebrating. The exodus might finally slow down. But here's the question nobody's asking. Who actually benefits? The phase-out structure meant different retirees got relief at different times, different birth years, different income levels, different pension amounts. Some retirees are just now getting full elimination. Some have been getting partial relief for 3 years already. And some retirees might not benefit as much as they think. Because not all retirement income is treated equally. Pension income is exempt, but investment income isn't. Dividends and capital gains still get taxed. How you structured your retirement savings decisions you made decades ago now determines how much you actually benefit from this change. Section 2 breaks down exactly who wins, how much they save, and the catches that could limit your benefit. Because the headline says pension tax eliminated, the fine print tells a more complicated story. Let's read the fine print together. Let's get specific. Because the headline says Michigan eliminated the pension tax. That's true, but it doesn't tell you what you'll actually save. The details determine whether this is a $1,000 windfall or a minor adjustment to your tax bill. Let's break down exactly how this works. The elimination didn't happen all at once. It phased in over 4 years. 2023 was the first year of the phase-out. Partial restoration of the exemption. Some retirement income became exempt, but not all of it. The amount depended on your age, your income, your birth year. 2024 brought larger exemption amounts, more income protected from taxation, more retirees seeing meaningful relief. 2025 expanded even further, most retirees seeing significant tax savings by this point, the exemption covering more and more of their retirement income. 2026 is the finish line. Full elimination, no state income tax on qualifying retirement income, period. Here's why this matters if you've already filed taxes for those earlier years. If you filed your 2023 taxes without claiming the new partial exemption, you overpaid. If you filed your 2024 taxes without claiming the expanded exemption, you overpaid. You left money on the table, money the state collected that they shouldn't have, money you can get back by filing amended returns. We'll talk about that in Section 3. For now, just know that the phase-out was already in effect. If you missed it, you might be owed refunds. The phase-out was designed to ease the budget impact. Michigan couldn't afford to eliminate the tax overnight. Too much revenue would disappear too fast. So they spread it out, gradual relief rather than a sudden shock to the budget. For retirees, that meant patience, watching the exemption grow year by year, waiting for full relief while still paying partial taxes. 2026 is when the waiting ends. Full exemption, no more partial relief, complete elimination. But here's what the headlines don't explain. Not all retirement income is treated equally. The exemption covers specific types of income. If your retirement is structured differently, you might not get the full benefit. Let me show you exactly what qualifies and what doesn't. Public pensions are fully exempt. If you worked for the state of Michigan, your pension is exempt. Teachers who spent their careers in Michigan classrooms, police officers who patrolled Michigan streets, firefighters who protected Michigan communities, municipal workers in cities and counties across the state. All of it exempt. Zero state income tax. Private pensions are fully exempt. If you worked for a corporation and earned a traditional pension, it's exempt. General Motors retirees, Ford retirees, any company that still offers a defined benefit pension plan. Union pensions, exempt. If you are a union member and your pension comes from a union pension fund, it's exempt. Any defined benefit pension from any employer, public or private, exempt. 401k distributions are exempt. Whether you're taking regular distributions in retirement or you've hit the age where required minimum distributions kick in, those withdrawals are now exempt from Michigan state income tax. This is huge because 401k plans replace traditional pensions for most workers over the past 40 years. The majority of today's retirees are drawing from 401k accounts, not pensions. Those distributions used to be fully taxable in Michigan. Now they're not. IRA withdrawals are exempt. Traditional IRA distributions that would have been taxed at 4.25% are now exempt. If you rolled over your 401k into an IRA when you retired, those withdrawals are covered. If you've been contributing to a traditional IRA throughout your career, distributions are covered. The money you saved in tax-advantaged retirement accounts stays tax-advantaged when you take it out, at least at the state level. 403B distributions are exempt. Teachers and nonprofit employees who saved in 403B plans get the same treatment as 401k savers. Social Security was already exempt. Michigan has exempted Social Security benefits for years. Nothing changes there. It was already tax-free and remains tax-free. So if your retirement income comes from these sources, pension, 401 KEK, IRA, 403B, Social Security, you're fully covered. No Michigan state income tax, period. But here's what catches people off guard. Investment income isn't covered. Interest from savings accounts and CDs, still taxable at 4.25%. Dividends from stocks and mutual funds, still taxable. Capital gains from selling investments, still taxable. If your retirement strategy relies heavily on taxable brokerage accounts instead of retirement accounts, your savings from this change might be smaller than you expected. Let me give you an example. Retiree A has $50,000 in annual income, all of it from a pension and 401k distributions. Under the new law, retiree A pays zero Michigan state income tax, complete exemption. Retiree B also has $50,000 in annual income, but it comes from dividends, capital gains, and interest from a taxable investment portfolio. Retiree B still pays Michigan state income tax on all of it, about $2,100. Same income level, same retirement, completely different tax bill. The difference is the source. Retirement accounts are exempt, investment accounts are not. How you structured your savings decades ago, decisions you made in your 30s and 40s now determines how much you benefit from this change in your 70s. Rental income isn't covered either. If you own rental properties and collect rent in retirement, that income is still taxable. Business income isn't covered. If you do consulting work in retirement, if you have a side business, if you're self-employed in any way, that income is still taxable. Wages aren't covered. If you work part-time in retirement, whether for spending money or because you need to, those wages are still taxable. The exemption is specifically for retirement account distributions and pension payments, not all income you happen to receive after you retire. The distinction matters a lot. And there's another catch that affects certain retirees: age requirements. Even with full elimination, some rules about when you can claim the exemption still apply. The full exemption applies to retirement income received after reaching certain ages. For most retirement accounts, you need to have reached age 59 and a half to qualify for the exemption on distributions. Taking early distributions before 59 and a half, those might not qualify. The exemption may not apply. This affects people who retired early and have been drawing down retirement accounts to bridge the gap before Social Security kicks in. If you retired at 55 and immediately started taking 401k distributions, check whether those qualified for the exemption during the phase-out years. Public pensions often have different rules. Many public pension systems allow retirement before 59 and a half with full benefits. Those pensions should still qualify for the exemption even if you retired early. But early IRA withdrawals, early 401 KEK distributions taken before 59 and a half, the treatment might be different. The rules are designed to cover traditional retirement income received at traditional retirement ages. Early distributions, hardship withdrawals, and other special situations may have different treatment. If your situation is complicated, talk to a tax professional. Make sure you're claiming everything you're entitled to and not claiming things you're not. Now, let's calculate what this actually means for your wallet. Michigan's state income tax rate is 4.25%, flat rate, same percentage regardless of income. Take your annual pension and retirement account income, multiply by 0.0425. That's roughly what you'll save each year. $30,000 in pension income, you'll save about $1,275 per year. $40,000 in combined retirement income, about $1,700 saved. $50,000 in retirement distributions, about $2,125 saved. $75,000 in retirement income, about $3,190 saved every year for the rest of your retirement. Let's put that in perspective. Say you have 20 years of retirement ahead of you. A $50,000 annual pension means roughly $42,000 in lifetime tax savings. That's not pocket change. That's a new car. That's several years of property taxes. That's a significant addition to your emergency fund. That's money you would have sent to Lansing that now stays in your pocket. And here's something else to consider. The savings compound in other ways. Lower state tax means lower total tax burden. Lower total tax burden might affect other calculations like how much of your Social Security gets taxed at the federal level, or whether you trigger IRMAA surcharges on Medicare. The ripple effects are real, the direct savings are significant, the indirect benefits might add even more. You now know what's exempt and what isn't. You know how to calculate your savings. You understand the catches that could limit your benefit. But knowing isn't the same as claiming. Section 3 shows you exactly what to do, how to make sure you're getting the full benefit on your 2026 taxes, whether you should amend your 2023, 2024, and 2025 returns to claim refunds you might be owed. And the bigger question, does eliminating the pension tax make Michigan a good retirement state now? Or are there still reasons retirees might look elsewhere? The numbers are in. Let's figure out what to do with them. The pension tax is eliminated. You know what qualifies. You know what you'll save. Now let's make sure you actually get that money. Because tax changes don't help you if you don't claim them correctly. The exemption exists, but you have to file your taxes right to benefit from it. Let's start with your 2026 taxes. Your 2026 Michigan income tax return will be filed in early 2027. That will be the first return with full pension tax elimination in effect for the entire year. When you file, your pension and retirement account income should be subtracted from your Michigan taxable income. It shouldn't be taxed. It should be removed from the calculation entirely. If you use tax software like TurboTax or H&R Block, the software should handle this automatically. The programs get updated with new tax laws. They should recognize Michigan retirement income and apply the subtraction. Should, but don't assume. Before you file, review your return. Look for the retirement and pension income subtraction. Make sure it's there. Make sure the amount matches what you actually received in retirement income. If you use a tax preparer, confirm they're aware of the change. Ask them specifically about the Michigan retirement income exemption. Make sure they're applying it to your return. Tax preparers are human. They handle hundreds of returns. They might miss something. They might not have caught the update. A quick conversation ensures you get what you're owed. If you file yourself using paper forms, look for the retirement and pension subtraction on the Michigan MI 1040. There's a specific line for it. Make sure you're filling it in correctly. Don't assume the exemption happens automatically. It doesn't. You have to claim it. Verify. Check your return before you file. Make sure the subtraction is there and the number is correct. If you see retirement income being taxed on your Michigan return, something's wrong. Stop. Figure out what happened. Fix it before you file. The whole point of this change is to save you money. Don't let a filing error take that away. But here's what a lot of retirees don't realize. If you didn't claim the partial exemptions in 2023, 2024, or 2025, you might be owed refunds. The phase-out was already in effect. The exemptions were available, smaller than the full 2026 exemption, but real money. If you filed those returns without claiming the retirement income subtraction you were entitled to, you overpaid your Michigan taxes. The state collected money they shouldn't have collected, money that's yours. You can get it back by filing amended returns. Here's how to think about whether it's worth the effort. Pull out your tax returns from 2023, 2024, and 2025. Look at how much retirement income you reported. Look at whether you claimed any Michigan retirement subtraction. If you didn't claim the subtraction, calculate what you would have saved. Take the exempt amount you were entitled to and multiply by 4.25%. If you're owed $200, maybe it's not worth the hassle. Amending a return takes time. You have to gather documents, fill out forms, wait for processing. But if you're owed $800, $1,200, $1,500, that's real money. That's worth a few hours of paperwork. Michigan allows you to amend returns for up to 4 years from the original filing deadline. Your 2023 return can still be amended through April 2028, plenty of time. If you used tax software originally, you can usually amend electronically through the same software. Pull up your old return, make the correction, refile. If you used a preparer, call them, explain what happened, ask them to prepare amended returns. They might charge a fee, but if the refund is large enough, it's worth it. If the refund is substantial, say over $1,000 across the 3 years, it's absolutely worth the effort. Don't leave your money sitting in Lansing. Go get it. So you're getting the exemption going forward, maybe claiming refunds for past years? But here's the bigger question everyone's asking. Does eliminating the pension tax make Michigan a good retirement state? Or did this change just make Michigan average instead of terrible? Let's put Michigan in context. Before this change, Michigan was one of the worst states in the Midwest for retirement taxation. Pensions fully taxed for anyone born after 1952. Retirement account distributions fully taxed. Retirees fleeing for Florida and Tennessee and anywhere that treated them better. Michigan was actively hostile to retirees. The tax code said so. After this change, Michigan joins a group of states that exempt retirement income from state taxation. That's a big shift, from worst to competitive, in 3 years. But how does Michigan compare to the best options? States with no income tax at all: Florida, Texas, Nevada, Tennessee, Wyoming, South Dakota, Alaska, Washington, New Hampshire, on interest and dividends. These states don't just exempt retirement income, they don't tax any income, no matter the source. Michigan can't compete with zero. If you want absolute tax minimization, a no-income tax state still beats Michigan. But here's the thing, zero income tax doesn't mean zero taxes. Florida has property taxes. Texas has high property taxes. These states make up the revenue somewhere. And they don't have your family. They don't have your friends. They don't have the lakes you grew up on or the communities you've been part of for decades. States that exempt retirement income specifically. Illinois exempts all retirement income from state tax. Pennsylvania exempts retirement income. Mississippi exempts it. Michigan is now in this category. Competitive with Illinois. Competitive with Pennsylvania. If you're choosing between Michigan and Illinois for retirement, taxes are now roughly equal. Pick based on other factors. If you're choosing between Michigan and Florida purely on taxes, Florida still wins. No income tax beats some income tax. But taxes aren't the only factor, and for a lot of people, they shouldn't be the primary factor. Here's what the analysis usually misses. Retirement isn't just about tax rates, it's about total cost of living, healthcare access, family proximity, quality of life. Michigan eliminated a tax that was driving people away. That's significant. That matters. But the decision to stay or leave should be about more than one line on your tax return. Let's look at the complete Michigan picture. Michigan still has the 4.25% income tax on wages and investment income. If you work part-time in retirement or live off dividends, you still pay. Michigan property taxes are moderate compared to neighbors. Lower than Illinois, about the same as Ohio, higher than Indiana. Michigan has no tax on Social Security. Never did. That was always a plus. Michigan now has no tax on pensions and retirement accounts. That's the new part. The combination means most traditional retirement income is now tax-free in Michigan. If you're a pension-heavy retiree, you worked for the state, or GM, or Ford, or a union job with a defined benefit pension, Michigan is now genuinely tax-friendly. Your pension is exempt, your 401k is exempt, your Social Security is exempt. You might pay very little Michigan income tax at all. If you're an investment-heavy retiree, you saved in taxable brokerage accounts, you live off dividends and capital gains. Michigan is better than it was, but not tax-free. The retirement account portion is exempt. The investment portion still gets taxed. For most retirees, this change is a significant improvement. Real money saved, real burden lifted. Michigan is no longer a reason to leave. It might even be a reason to stay, or a reason to come back. The retirees who left for Florida in 2012 because of the pension tax might be reconsidering. Michigan winters are brutal. That's not changing. But zero pension tax and family nearby and lakefront summers and autumn color and communities, you know? That might be worth the snow. Here's your action plan. 5 steps to make sure you benefit from this change. Step 1. Confirm your retirement income qualifies for the exemption. Pension income. 401k distributions. IRA withdrawals. 403b distributions. These qualify. Investment income, rental income, wages. These don't. Know what category your income falls into. Step 2. When you file your 2026 taxes, verify the Michigan retirement subtraction is applied correctly. Don't assume, check. Look at the return before you submit it. Make sure the subtraction is there. Step 3. Review your 2023, 2024, and 2025 Michigan returns. Did you claim the partial exemptions that were available during the phase-out? If not, consider amending to claim refunds. Step 4. If you work with a tax preparer, confirm they know about the change. Have a direct conversation. Ask them specifically about the Michigan retirement income exemption. Make sure it's on their radar. Step 5. If you've been considering leaving Michigan for tax reasons, recalculate. The math has changed. The factors have shifted. Rerun the numbers with the new exemption in place. You might find that staying makes more sense than it did 3 years ago. If this video showed you money you didn't know you were getting, subscribe. We cover tax changes the moment they happen, the state-level shifts that affect your retirement, the exemptions and deductions that put money back in your pocket. Drop a comment. Are you a Michigan retiree? How much will you save from this change? Were you considering leaving before the pension tax was eliminated? I'm genuinely curious, because this affects 500,000 people, and I want to know if it's changing their plans. Thanks for watching. See you in the next one. For 15 years, Michigan retirees paid a pension tax that felt like punishment. Punishment for choosing Michigan, for retiring here, for staying when other states rolled out the welcome mat and said, come on down, we won't tax your pension. That tax is gone now. Eliminated, repealed, finished. It took 15 years. It took a lot of advocacy. It took a lot of retirees leaving before legislators finally understood the damage they were doing. But they acted. Eventually. Finally. Michigan is now a state where retirees can keep their pension income. All of it. The state that was bleeding retirees might start keeping them, might even start attracting them. If you've been paying this tax, watching that money disappear year after year, your burden just lifted. If you left because of this tax, packed up your life and moved to a state that didn't punish you for retiring, the door is open. Michigan wants its retirees back. This time, they put their money where their mouth is. Welcome home.